SSR Mining Inc. presents a complex investment scenario defined by a severe geopolitical risk premium applied to a fundamentally robust and actively de-risked operating portfolio. The company, an intermediate gold producer, successfully navigated the indefinite suspension of its flagship Çöpler mine in Turkey by executing a rapid, strategic pivot centered on the high-quality acquisition of the Cripple Creek Victor (CC&V) mine in the United States and maintaining an exceptionally strong balance sheet. The core tension is the disconnect between SSRM's strong underlying cash flow generation, its net cash position of $179.3 million, and a valuation that trades at a deep discount to its intrinsic worth. The current market price appears to reflect the value of the operating assets outside of Turkey, effectively assigning a minimal or zero value to the suspended Çöpler asset. This structure creates a high leverage opportunity. Any positive resolution regarding the Turkish operations would likely trigger a significant multiple expansion. The analysis concludes that SSRM is undervalued based on traditional metrics, with the discount serving as a margin of safety against the geopolitical risk. The strategic commitment to organic growth, particularly the self-funded advancement of the Hod Maden copper-gold project, suggests management confidence in the long-term viability of the portfolio. A. Corporate profile, operating footprint, and strategic positioning. SSR Mining Inc. is headquartered in Denver, Colorado, and focuses on precious metals production. Its operations are highly diversified geographically, spanning 4 major global precious metal districts: the USA, Turkey, Canada, Seabee, and Argentina, Puna. While predominantly focused on gold production, the Puna operation also provides silver and base metals, notably lead, contributing to revenue stream diversification. A. Strategic portfolio transformation. Following the indefinite suspension of operations at Çöpler, the company's strategic priority shifted towards stabilizing cash flow and reducing jurisdictional dependence on Turkey. The centerpiece of this strategy was the acquisition of Cripple Creek Victor (CC&V) in Colorado, USA, which closed on February 28, 2025. This acquisition immediately introduced high-quality, low-cost production from a Tier 1 jurisdiction, USA, profoundly altering the company's risk profile. The asset also significantly bolstered the reserve base, reporting 2.4 million ounces of gold as of December 31, 2025, representing an 85% increase over its prior inventory levels. The immediate operational impact of CC&V was significant. In the second quarter of 2025, CC&V produced 44,062 ounces of gold at an all-in sustaining cost of $1,339 per payable ounce. This low operating cost structure provides a vital foundation for stable, high-margin production, insulating the company from the volatility associated with its Turkish operations. This tactical deployment of capital to acquire CC&V served a critical de-risking function. By substituting the uncertainty of high-risk Turkish volume with reliable, low-cost US-based volume, management effectively contained the operational fallout from the Çöpler incident, while concurrently lowering the overall jurisdictional risk of the consolidated entity. This maneuver ensures a necessary, robust stream of reliable cash flow, which is paramount for funding future organic growth projects and maintaining financial stability.
Financial strength and capital structure resilience. SSR Mining's financial results for the third quarter of 2025 demonstrate exceptional resilience and financial fortification achieved despite the non-productivity of a major asset. A. Q3 2025 performance and margin expansion. The third quarter of 2025 highlighted the successful portfolio diversification and benefited significantly from elevated precious metal prices, with average realized gold prices reaching approximately $3,500 per ounce. Financial performance indicators were strong. Total revenue surged to $385.84 million, reflecting a substantial 49.9% increase year-over-year. Net income reached $65.44 million, translating to a massive year-over-year jump of 519.9%. Adjusted net income was $68.4 million, or 0.32 cents per diluted share. B. Cash flow quality and allocation. An analysis of the cash flow metrics reveals a high-quality cash-generating engine actively funding future growth. While the reported free cash flow, FCF, for Q3 2025 was negative $2.4 million, this figure is not representative of core operating performance. Operating cash flow and FCF before working capital adjustments totaled a strong $132.1 million and $72.5 million respectively in the third quarter. The negative reported FCF was primarily driven by strategic uses of capital, increases in inventory movements, build-up at the Marigold and CC&V mines, and prepayments associated with the development activities for the Hod Maden project. Specifically, $17.1 million was spent on Hod Maden development during the quarter. The divergence between the reported FCF and the underlying $72.5 million of cash flow generated before working capital adjustments is strategically important. It confirms that the company is generating substantial, high-quality cash flow that management is proactively channeling back into future growth projects and increasing working capital assets, inventory, rather than distributing the full amount. This disciplined approach to capital allocation demonstrates the financial stability required to pursue major organic growth projects, even while managing the indeterminate status of Çöpler. C. Balance sheet strength and leverage. SSR Mining maintains a robust and de-risked balance sheet, providing essential liquidity against operational shocks and geopolitical volatility. As of September 30, 2025, the company held $409.3 million in cash and cash equivalents. Total liquidity, including the company's undrawn revolving credit facility and accompanying accordion feature, reached $909.3 million. Total gross debt stands at $230 million. The comparison of cash and debt results in a significant net cash position of $179.3 million. Maintaining a net cash position is highly favorable in the volatile mining sector, particularly for companies operating in politically sensitive jurisdictions such as Turkey and Argentina. This superior liquidity minimizes refinancing risk, protects the company against immediate funding crises related to jurisdictional shocks, and grants management maximum operational flexibility to manage the current situation in Turkey.
Operational performance and cost structure deep dive. The operational metrics for 2025 reflect a company absorbing substantial non-productive costs related to the Çöpler suspension, while sustaining strong output momentum from its remaining mines, augmented by the CC&V contribution. A. Production profile and guidance. Consolidated production for the third quarter of 2025 reached 102,673 gold equivalent ounces, GEOs. Year-to-date production through the third quarter totaled 326,940 GEOs. The full year 2025 production guidance is expected to settle in the lower half of the 410,000 to 480,000 GEO range. This guidance is generated solely from the Marigold, CC&V, Seabee, and Puna operations, excluding any contribution from Çöpler. The production profile is weighted toward the latter half of the year, a common feature, with Marigold specifically expecting 55 to 60% of its production in the second half of 2025. The Puna operation in Argentina provided critical diversification, producing 2.4 million ounces of silver in Q3 2025, bringing the year-to-date silver production to 7.76 million ounces. B. All-in sustaining cost AISC analysis. The consolidated cost structure is currently elevated and requires normalization to reflect the true operational efficiency of the producing mines. The reported consolidated AISC for Q3 2025 was high at $2,359 per payable ounce. However, when normalized by explicitly excluding the non-productive care and maintenance expenses related to the Çöpler suspension, the AISC drops to $2,114 per payable ounce. The company's full-year 2025 cost guidance, exclusive of Çöpler C&M expenses, anticipates a consolidated AISC range of $1,890 to $1,950 per payable ounce. Although management expects costs to trend toward the upper end of its consolidated guidance ranges for 2025, the key drivers for this upward pressure are linked to high revenue realization, higher than expected royalty costs tied to the elevated realized gold price, and increased share-based compensation driven by the company's strong stock price performance. While a normalized AISC near $1,900 per ounce is above certain industry averages, the financial impact is minimal due to the high average realized gold price of approximately $3,500 per ounce. This pricing generates an exceptional cash operating margin, confirming that margin integrity remains robust even with the elevated cost base. Furthermore, the fact that revenue-linked costs, royalties, performance compensation are identified as key drivers suggests that the high cost structure is in part a manifestation of the company's strong financial performance rather than a fundamental operational weakness caused by inflation. Growth pipeline and future production drivers. SSR Mining is committed to substantial, self-funded organic growth, focusing capital allocation on advancing key development projects and extending the life of its operating assets. A. Hod Maden Project Advancement. The Hod Maden copper-gold project in Turkey is recognized as the most significant element of the long-term growth profile. It is consistently referred to as one of the most compelling and highest-returning undeveloped copper-gold projects in the sector. Development activities are proceeding aggressively despite the uncertainty at Çöpler. Planned development capital for Hod Maden in 2025 on a 100% basis is estimated between $60 million and $100 million. During Q3 2025, $17.1 million was spent as engineering and initial site establishment efforts progressed. Key activities planned for 2025 include the commencement of road and tunnel development for site access. The project is projected to begin contributing to consolidated production by 2027. A construction decision and updated life of mine plan are expected in the months following Q3 2025 reporting. B. Capital expenditure and exploration strategy. Beyond Hodmanen, the company is ensuring future reserve replenishment and pipeline longevity. Total growth capital expenditures for 2025 are projected between $100 million and $140 million. Additionally, the 2025 budget includes $50 million dedicated to growth exploration and resource development. This commitment includes ongoing technical work to deliver an updated life of mine plan for the newly acquired CCNV operation within 12 months of the acquisition close. The capacity of the company to commit to over $100 million in growth capital while maintaining a net cash positive balance sheet and generating strong positive underlying cash flow confirms exceptional financial self-sufficiency. This financial advantage allows the company to build out its future production profile, projected to be over 10% year-over-year growth for 2025, without relying on potentially dilutive external financing, thereby protecting shareholder equity. Investment risk assessment. The primary risks facing SSR Mining are almost entirely external, tied to regulatory and political developments in its operating jurisdictions. A. The indeterminate status of Çöpler, Turkey. The indefinite suspension of the Çöpler operation remains the central concern and the principal source of the valuation discount. The company has explicitly stated that it is unable to estimate or predict when or under what specific conditions operations will resume. Restarting the mine is contingent upon the reinstatement of all necessary regulatory approvals, including operating permits, by Turkish governmental authorities. While management has indicated constructive discussions are ongoing, the uncertainty persists, presenting a binary outcome: either a return to production, leading to significant value realization, or a prolonged suspension or decommissioning, which is currently heavily discounted into the share price. The continued investment in the Hodmaden project within Turkey presents a unique strategic commitment that demands attention. Committing substantial development capital, up to $100 million in 2025, to a large-scale project in the same country that indefinitely suspended its flagship mine strongly suggests that management's internal assessment views the Çöpler incident as a localized or temporary regulatory challenge, rather than a systemic, unsurmountable failure of the entire Turkish jurisdiction. This willingness to proceed with Hodmaden development acts as a counterbalance to the current regulatory fears.
B. Geopolitical and regulatory exposure. Beyond Turkey, the company is subject to risks in its other operating environments. The Puna operation in Argentina, for example, exposes the company to general risks associated with local and global political and economic conditions, changes in government policy, and volatile regulatory factors. Valuation analysis and investment recommendation. The valuation metrics for SSRM confirm a significant disconnect between the company's financial performance and its market capitalization, a gap directly attributable to the persistent geopolitical risk. A. Comparative multiples and discounting. The company trades at favorable comparative multiples, suggesting it is undervalued relative to peers and industry averages. Price-to-earnings (PE) ratio. SSRM's PE ratio stands at approximately 19.8x. This is competitive compared to the peer average of 24.1x and the broader U.S. metals and mining industry average of 22.1x. Historically, SSRM's 9-year average PE was 32.32x, indicating the current multiple is trading at a steep discount to its own historical pricing. Price-to-book (PB) ratio. The PB ratio is reported at a very low 1.13. For a mining company with significant proven mineral reserves, such as the 2.4 million ounces recently added at CCNV, a PB value close to 1 implies the market is assigning a substantial discount to the perceived value of its resource base. This low multiple provides quantitative evidence that the market is pricing in either severe future impairment or the sustained non-productivity of the Turkish assets. B. Intrinsic value assessment. The most critical valuation indicator is the discount relative to the estimated fair PE. The current PE of 19.8x is deeply discounted compared to the estimated fair price-to-earnings ratio of 37.3x. This 50% valuation discount quantifies the geopolitical risk premium that the market has applied to the stock. Crucially, this discount exists despite the company possessing robust forecast earnings growth of 55.40%. In normal operating environments, such high projected growth rates would typically command a premium multiple, not a discount, further confirming that the Çöpler risk narrative overrides positive fundamental performance. C. Analyst consensus and price targets. Analyst sentiment reflects the underlying uncertainty, leading to dispersed forecasts. The consensus rating aggregates around a hold recommendation. However, price targets reveal substantial implied upside. Based on targets offered by 10 analysts, the average price target is $27.23, representing a potential upside of 27.6% from recent trading levels.
The forecasts exhibit wide dispersion, ranging from a low of $18.70 to a high of $33.37. The upper tier target of $33.37 implies a significant 56.37% upside and likely models a scenario incorporating the successful and timely restart of Çöpler operations, fully valuing the asset base.
Synthesis and investment conclusion. SSR Mining has demonstrated exceptional management agility in de-risking its portfolio through the CC&V acquisition and solidifying its financial position with a net cash balance. The company's core non-Turkish operations are generating strong, high-margin cash flow, which is being effectively utilized to fund future growth at Hod Maden and increase working capital. The investment decision centers on the willingness to capture the significant value inherent in the company's strong fundamentals, which are masked by the Çöpler geopolitical risk. The stock is currently trading at a discount to its intrinsic valuation and peer group, implying that the indefinite suspension of Çöpler is largely priced in. The combination of substantial liquidity, a net cash balance sheet, high forecast earnings growth, and a valuation discount of nearly 50% relative to the fair PE presents a compelling case. The most significant catalysts for share price appreciation would be a positive ruling or timeline regarding the reinstatement of permits for Çöpler, or a successful construction decision and further de-risking of the Hod Maden project. The current pricing provides an adequate margin of safety, making it an attractive prospect for investors seeking exposure to the gold sector who are prepared to accept the volatility associated with the potential realization of the substantial discounted option value embedded within the Turkish assets.